Well, if I sound a little bit dejected, it's because I just ruined a 45-minute Q&A. That stinks. I'll just say it right out loud. Okay, so let's go ahead and get started again. Referring to the special video you've posted this week, can you please go over again the calculation regarding 52 pips worth of profit versus 65 pips worth of risk? Well, first of all, the examples that I gave in that video were hypothetical. Okay, they were practice. They weren't meant to be any kind of trading system. It was just an example to try and get you thinking in terms of profits and loss. And my suggestion to you, because the person is asking me, what I'm interested to know is how are you going to make the 52 pips in terms of setting the trade positions? What I would say to you is do those calculations for yourself. That I wanted to give you examples so that you could go in and do some of this work and start understanding what really makes a trading system work. Okay, so if you're exiting if you're exiting 80% of the position at 20 pips worth of profit, and you're exiting 20% of your position at some other profit level, you're going to have to figure out what are the ratios. Okay, so the basic answer is you got to do the work for yourself. I'm going to go over some of. There's another question in today's Q&A where I'll wind up addressing this in some fashion. But really, you got to plug the numbers in for yourself. By the end of this Q&A, you'll have some more ideas on how to do that. Next is I have a question regarding when to trade the cable. I know in your trading plan you mentioned the sweet spot, but I was wondering if that's set in stone. Yes, absolutely, that's set in stone. Why is it set in stone? And this is where the last Q&A got derailed. Oh, it was a thing of beauty, and then it got wrecked. So let's hope that this one, now that I've actually gone through it once, this one will be better. There you go. What you're getting now is a refined version. It's like fine wine. It's refined. Okay. There's a lot that goes into that. Why is the sweet spot set in stone? Well, first of all, you've got to understand how the market works. Okay? Now, the basic description, let me say this, I think this is wrong, is that for each buyer, there is a seller. Okay? I think that's a wrong way to look at the market. It's mechanically correct, but it's the wrong way to look at it. Okay? Why is that? Well, because price moves in relation to demand first and supply later. Okay, the real key to understanding, I think, any traded market is demand. I really don't think supply has that great of an impact on it. Why? Because you could see supply go up tenfold and demand make significant increases to soak up the supply. Okay? You can even create demand artificially. I mean, you can look at Tickle Me Elmo. I mean, look at the Beanie Babies, for crying out loud. Artificially creating demand. Now, is there a limited supply of Beanie Babies? I would say, in essence, no. So supply, in essence, for practical terms, is unlimited, because theoretically you could make more Beanie Babies than people have money. So, is there a limited supply? No. Is there an unlimited demand, or can you artificially stimulate demand? Yes. So, let's take a look at demand. Why is the sweet spot important? Okay,